Okay, dear students, I'm welcoming you here back at this class, and we're going to continue studying the issue of the central banking system in the United States. The prelude to the international financial crisis of 2008-2010 was a really prolonged type of prelude. Things were just accumulating. The problems of the mortgage-backed securities was increasingly getting worse and worse and worse. People did not understand the meaning of the financial debts they had accumulated through the years. They started accumulating debts in the 1970s, 80s, and 90s. But basically, of course, in the early 2000s, that was a really harsh period of financial kind of surge in the house prices, especially. So, what was this period about? This period of the early 2000s was a period of really low interest rates, and people were just happy about taking those mortgages because it was a really a good thing for them to start buying homes. This formula of buy your own home became really important for the majority of the population in the United States. And they started building new homes. The construction industry was on the rise. Everything was okay. Like you know, if one industry, at least one industry such as the construction industry, is working really effectively, then what really happens is that economic growth just comes to other areas, because construction industry is sort of helping other economies in taking some jobs and providing jobs opportunities. And then of course the system of construction industry is really helpful for the general economic conditions in any country. If we take the United States economy or the economy of Russia, any kind of economy in the world, the construction industry is sort of really important in providing job opportunities. So the economic growth starts really helping this kind of economic relations. And when it comes to a surge in prices, people start thinking that the homes are getting really good in value. The value of the homes is increasing actually dramatically. And the early 2000s was a period of a real growth in the house prices. Prices were soaring, and everything was okay. People were just happy. When your homes are getting bigger in their value, that means they're becoming more expensive, and that leads directly to a feeling that everything is possible in this world. You start thinking about taking more loans and credits, and people were just doing that. So they started taking those loans and credits in order to buy something else. Some people bought cars or just a garage for their car. They took thousands of dollars in their balance sheets. This was really a period of hot economic development. And then of course there were low interest rates in this period. If in the 1980s there was a period of really high interest rates and people taking their mortgages were not welcomed in the banks, because banks demanded many documents to make sure that you're going to pay them back. So, for example, a 33-year mortgage loan in Texas or Louisiana in those days was something like 18% a year. That was a really high interest rate on the mortgage, and people were also obliged to provide very many documents to ensure that their ability to pay back their loans was kind of secured. And the markets and the financial markets were really under control. The liberalization process has just began, but the real liberalization, financial liberalization began later, a bit later in the 1990s, in the early 1990s, or in late 1980s actually. There was a Big Bang. Big Bang is the situation which is that is called Big Bang, the situation when Margaret Thatcher, the Prime Minister of Great Britain, issued a program in 1986 saying that we're going to start a Big Bang, the financial Big Bang in the financial city of London. The London Financial Centre became the financial centre of the world, international or global financial centre. Its index of among global financial centers was the highest. Its ratings were the highest, and people made sure they wanted to enter that particular market. They issued their bonds in this market. They started selling their shares more frequently, and this period was, of course, again the period of high economic growth in the financial industry. In the late 1980s and early 1990s, then came other big bangs in other economies, the United States. In the early 2000s and late 1990s, there were, of course, economies such as Germany, France, many other European countries. They also started this financial revolution. Internet technologies provided really huge opportunities in developing new financial industries, new financial products. Everything became really cheap. The transactions and transfers of money, financial flows, money flows became really effective and easy. You could trade in any kind of market in the world, in the stock exchange especially, so you could buy and sell foreign assets, foreign exchange. The majority of transactions were made in the US dollars, of course, and the second place is, of course, was taken by the euro, and as still today the euro is still the currency number 2 in world transactions. Of course, there are other currencies such as Swiss francs, Chinese yuans, the euro, Japanese yen, Swiss francs. These currencies are international reserve currencies. Yuan was included in the basket of special drawing rights on October the 1st, 2016. That's the newest development in this area. But actually, in 2008, when crisis began, so what were the factors of especially this kind of crisis? So I was talking a lot about interest rates and mortgage opportunities, and this was the period when people just lost control in their financial matters. Interest rates were low, and they started getting more and more mortgages. They purchased homes, cars, everything actually in credit. The economy was getting really heavily indebted. Every person in the country was really heavily in debt. And then came the collapse, some sort of big bang. Warren Buffett called these financial instruments the weapons or financial instruments of mass destruction, derivatives. The subprime mortgages with no documentation, with low interest rates, became that sort of bomb that exploded in 2006, 2007. There were a really difficult situation in these mortgage in the financial markets in the United States. And after that, there was a period of serious economic distress. So inflation aroused price psychology was one of the major factors in transmitting and distributing negative economic effects in the US economy. They started injecting money, and that was one of the problems again, because printing money always leads to inflation, but that was not the case in the United States. Inflation was exported to other nations because issuing dollars was a major countries were especially such as the BRICS nations were, of course, also hit by the financial crisis. Really, everything started in 2009, actually, when these economies were also under threat, because these countries, the BRICS countries, are major exporters to the world economy, to the United States and many other nations. Russia is the greatest provider of oil and gas, and Brazil also exports many resources. It is really competitive in producing biodiesel and things like that, and fuel and eco-fuel, so to speak. India is the leading nation in producing some sort of information technology and things such as pharmaceuticals. China is the world factory and is the leading exporter in the world. So South Africa actually is really a small country in the BRICS, conglomerate of countries, in this international block of countries. So South Africa is really small, but still it provides resources such as gold and other types of minerals, really precious stones and things like that. So these countries were also hit by the crisis, and every country in the world actually suffered, and they started devaluing their currencies. That was the only way to overcome this crisis. Some economies tried to declare defaults and devalue their currencies. Especially difficult situation there was in Europe, in the Eurozone. In particular, the PIGS nations, such as the PIGS means Portugal, Ireland, Iceland, Greece, and Spain. So these nations were the hardest hit in the financial crisis. It actually was called the European debt crisis, people started withdrawing, other nations, other banks started withdrawing capital from these smaller countries. Greece was especially hit by the economic collapse. Everything started everything became really shaky. The economy it could collapse, but it was not allowed to collapse because Greece is in the system of nations, and this country, Greece, is a member of the Eurozone. It has euros in the circulation, in the money circulation, so it could not declare default in 2009, and the situation was really harsh. There were many riots in Greece because the European Union, in order to help Greece come out of the recession, introduced some austerity measures, which included cuts in wages, cuts in the employment in government institutions. People were made redundant. Many people lost their jobs, their salary was decreased, as well as wages and salaries. Before 2008, in Greece, there was an economic boom, because before introducing the euro, Greece was on the drachma. Drachma was the national currency of Greece, and before entering the eurozone in 2002, 2001 actually. So before entering the eurozone, Greece was the last country to join the European Union, the eurozone. That was the last country of 12 countries in those days, in 2001. Today it's of course 18 countries, but in those days it was just these 12 nations. He joined the European Monetary Union, and their currencies were obsolete and came out of circulation. That was a period of really great economic challenges. Greece was a weak economy, and what that meant, the introduction of euro in Greece, meant that interest rates went down to the German level, to the level of Finland and Austria, countries, really stable countries in the European Union. Before that, in Greece, you could take, of course, loans, but interest rates was something like 15, 18%, and just like in Russia. And people were not interested in taking those loans in great quantity. But later, when they joined the European Union, the Euro Monetary Union, the monetary union of 12 nations, interest rates decreased down to a German level of 4 and 6%, and people were happy about that. They went crazy, they went on a spending spree. They started buying homes, luxury cars. For example, they started purchasing Porsches in Germany. This is a really luxury car, and they started purchasing those cars in great quantities, and started purchasing homes, yachts in the Mediterranean. Many Greeks had yachts in the Mediterranean. They did not pay any taxes, or these taxes were really low in Greece. They were really low tax rates, really low taxes, unlike Germany, where taxes were really high, especially in France. and other nations. So this was a situation when politicians did many mistakes in this sphere, in this area. The problem was with these nations that they started with Greece, Spain, Portugal. They were the periphery nations. They were really weak, and actually they shouldn't be allowed to join this European monetary union, because their economic power, their economic potential was not so high as in Germany or in France, and their prices were not so stable. Of course, Italy especially was a country of high inflation. Inflation in Italy was something like 40%, just like in Russia in the late 1990s and early 2000s. Inflation was a real problem, and in Italy it is still the problem. But in Germany, Finland, Austria, the Netherlands, countries such as this, the northern countries of the European Monetary Union, they were the most stable in terms of prices. They were the lowest interest rates, and they were the providers of capital. They were the richest nations in the European Monetary Union. Unlike countries of the south, of the periphery nations, and they just went on a spending spree, and then there were many financial difficulties. When banks in the United States started withdrawing their credits from Greek banks, there was a series of bankruptcies and runs on the banks in Greece. They went bankrupt, and Greece actually as a country was on the brink of collapse. But the problem is that being a member of the European Monetary Union, you could not get out of this system. You could not. They could not introduce their drachma again, because they were obliged to submit to some legislation which was commonly introduced for the 12 nations. There was a preliminary treaty, and they introduced this these sort of laws, this sort of financial system was working really. First, it was a really effective system. Many Greeks were happy that their weak drachmas were exchanged for the stronger euros. But later they started thinking that it would have been better if they did not join the European Union. Still, they continued this sort of system continued through the economic. There was a really economic hush phase. Everything started being really shaky, and after that they did not allow. Greece became more competitive, and this nation became really a bit more competitive than it was just in the beginning of this sort of crisis. But still, the competitiveness of Greece is really poor. I mean, the competitiveness in the region as well as in the world. Greece, what can it provide actually? What sort of products can it produce, and what things, what kind of things can it produce in order to overcome their economic and financial difficulties? This is a tourism nation, and they live selling tourism goods and services. And Greece was also helped by the International Monetary Fund. It was provided with extensive credit lines. First there was this package of $28 billion, then $30 billion. So Greece was actually being helped by the International Monetary Fund. They started this great period of economic hardship, and they had to go through many economic difficulties. The United States Central Bank, the Federal Reserve, took part. It was active in its policies, unlike in the Great Depression. The Great Depression, they learned some of the things from the Great Depression, and they started new policies. For example, the United States Federal Reserve System started concluding bilateral swap agreements with other central banks, in particular the central banks of the European Union. There was this sort of conglomerate of central banks, which was called C6, central banks of 6 major countries in the world: the United States, Bank of England, Germany's Bundesbank, France's National Bank of France. So banks such as these, they concluded bilateral swap agreements providing liquidity, and the economic collapse of 2008 was it sort of really slowed down a bit, and this helped to generate more economic opportunities. Interest rates were really low in order to stimulate the economy. They wanted to stimulate other countries and nations. They provided capital to the developing nations. The BRICS countries were also helping in this situation. China signed at least 28 bilateral swap agreements with the central banks of the world. First, they signed these agreements with countries of Southeast Asia, so countries such as Malaysia, Singapore, Japan, South Korea, Hong Kong. Of course, Hong Kong is not a nation, but still it's sort of semi-independent state, but still it's part of China. But there is a bilateral agreement between Chinese Central Bank, the People's Bank of China, and the Hong Kong Monetary Authority. So this was a period of great economic difficulties, and of course the United States Federal Reserve System played a really important role in stopping this financial crisis. And today we can postulate that the world economy really started getting back on its feet. Many nations started their slow way back onto the pre-crisis economic growth rates. Russia is especially Russia in the BRICS. In the BRICS bloc, Russia today became sort of a weak link, not because of the world financial crisis, but because of these sanctions which were introduced in 2014, 15 and 16. So in Russia we have this financial crisis and economic crisis not due to the world economic crisis, but especially this trade war between the European Union against the European Union and other nations. Of course, we're trying to do some stimulating activities. The government is trying to do something in order to stimulate the economy, but we are doing it really slow, and there are many economic issues which cannot be solved really quickly. So we are trying to overcome all those difficulties in some sort of way which is not really effective. We've got financial reserves, gold reserves, foreign exchange reserves, which we use in order to provide capital for our economic development. But we're doing it, the things are accumulating, and we start thinking about some sort of economic crisis which is going to continue in the period of 2016 through to 2026. So some economists say that there's going to be a really prolonged sort of recession, a really prolonged sort of economic crisis in Russia, and we are going to face some really harsh economic conditions. But again, I say this is not because of the general world economic crisis, world financial crisis, but because of this international sanctions policy of the United States and the European Union and other nations against Russian foreign policy, so to speak. So the opportunities of these countries, the investment opportunities of Russia started their way backwards, their way down, their downward slide. Russia faced some sort of financial difficulties, which it did try to overcome these difficulties, and in some of the things, in some of its economic policies, Russia was really competitive. The Russian government was really successful, but for these trade sanctions, international sanctions against Russia and its policy in the Ukraine, and its ambitions for the world economic leadership. Actually, this is a myth, of course. They try to just make people believe that they're going to be some sort of policies which are really difficult to implement, and they start thinking about economic problems which Russia has accumulated through decades of economic hardship, it went through in the early 1990s and late 1990s, when there were a series of economic collapses and things like that. Really, they were not so successful in providing opportunities, jobs opportunities. So this was a period of great economic hardship for Russia. But in 2000s, in the early 2000s especially, when oil prices started soaring up, Russia came again. It came back onto the world stage, and everything started. So this was a period of good economic opportunities. We were getting richer and richer. We went on a spending spree in Russia. We started building homes, we started buying cars. So things started to improve, really. That was the situation, like the situation in the United States. It can be compared with that, but still Russia was way back and is still way back behind the US and other European nations, and such as these countries, such as these. The aftermath of the house price bust in the United States and many other nations was really hard, and that was a first market sign, market signal. That was the first market signal for the people to just sort of understand that they did really bad when they took those loans, and they did not think about the consequences of their financial So things were accumulating, and the financial crisis was getting worse and worse and worse. It was becoming a global threat for the economic growth in other nations. Mortgage delinquencies and foreclosures, there was the wave of mortgage delinquencies and foreclosures. It really surged, and after that, banks and other holders of mortgage-related securities suffered sizable losses, which was a key trigger for the global economic crisis. So what was the situation? The situation, like I said, was really hard, and there were meetings, especially a very distinguishing feature in the global economic crisis of 2008 and 2010 was the economic cooperation between the countries, between many countries that were involved in the world financial system, which were the leading financial nations in the world, such as Great Britain, France, Germany, the G7 nations, actually. They were sort of countries that helped to overcome financial difficulties in this period, and they just kept doing really good things. They provided free float of cash. They provided investment opportunities for other nations, and they, like I said, they made bilateral swap agreements And these agreements were part of central banking policy that again helped these nations, these countries in their financial distress, in their financial downturn. Actually, thinking of going back to the Great Depression, we should say a few things that in those days there was this sort of economic cooperation or international cooperation was not really effective, and people were not really sure about the central bank was not sure that it could do the things which were generally accepted and which were recommended by economists such as Budget, like we know, and this Budget's rule was you should give capital freely, short-term capital freely to commercial banks, and this would help the economic system and the banking system stay afloat. Whereas so they did not do this in the Great Depression. The Central Bank of the United States, the Federal Reserve System, was really reluctant about doing this, because they feared if they provide cash freely, that would lead to speculative attacks. They were afraid of decreasing interest rates first, because they felt like, again, in the Great Depression, before 1933, actually, the U.S. was still on the gold standard, and the United States government, the officials in the Federal Reserve System, were really afraid of decreasing interest rates, the Fed fund rates, because, like I said, they were on the gold standard. Gold standard, of course, means that you should keep price stability, and price stability could only be kept through measures such as these. So, keeping interest rates high in order to stop speculative attacks and stopping other financial speculations. This sort of lesson was learned. This sort of lesson was a leading factor in dealing with the financial crisis in this particular situation in 2008, when the leading nations, the leading politics of the world, of the G7 countries came together, and they started making sure that the financial markets could still have some investment opportunities. They provided liquidity, the dollar liquidity, to the financial markets in order to calm them down, because the financial distress and the financial chaos was really on the rise. This sort of financial tsunami was on the way, and the financiers, the bankers, industrialists, they all feared about spreading this sort of economic hardship. So it's important to distinguish, of course, between triggers and vulnerabilities. How a housing bust became a financial crisis. A trigger and the vulnerability are different sort of things, because a trigger is a factor which just sort of make things happen. So a trigger is a sort of thing which just is the last point, is the last sort of limit, is the last sort of bastion before everything collapses, before everything goes bust. Whereas vulnerability is a sort of situation when the economy is on the rise, so things seem to be normal, life is good, but then there are vulnerabilities. So you've got weaknesses and strengths. The vulnerabilities can be compared with weaknesses, of course, in this sort of situation. And people started thinking that this sort of situation could lead to great economic challenges and great financial distress. And this is what happened. And so these are vulnerability and a trigger. In this situation, in 2008-2010, the decline in house prices and the associated mortgage losses were key triggers of the crisis. But the effects of those triggers were amplified by vulnerabilities in the economy and the financial system that accumulated over the years. There are many kinds of vulnerabilities in the financial and industrial system, and one of them is leverage. During the Great Moderation, borrowers and lenders took on too much debt, and taking more and more credits and loans led to a high level of indebtedness, because people just went on a spending spree. Like I said, they purchased, bought everything in credit. So this was a really difficult, this was a period of just like the Roaring Twenties. The party was on, and nobody believed that this party could ever come to an end. And especially they thought that they could still sell their assets and again be happy after that. But the problem is that during any financial crisis, everyone is losing money, and their assets become valueless. So you've got the situation of, especially when you think about growth opportunities in the financial system in the early 2000s, many people went on to the financial markets, international financial markets, where they just bought and sold shares, bought and sold international currencies, foreign exchange. And so they were really good at it. There was a whole industry was created. And people started doing business from homes, sitting just in front of their computers, and making things worse because they increased the number of participants in the markets. And so this was a period of a very important economic challenges, very important financial innovations. But these innovations, of course, first they provided capital, provided extra or additional capital. So people went on a spending spree, and the party was on, and the financial distress was accumulating, and this vulnerability was a really an important trigger for the economic collapse in the United States and in other countries such as Greece, Portugal, Spain. In Europe, if you think that in Europe things were okay, and this is not the case, because they did the same things. They also, in Spain for instance, they also purchased villas in the Mediterranean, on the Mediterranean shore. They bought yachts and things such as this. They bought or they purchased really luxury goods, and that was a huge miscalculation. They believed in that in the future this situation would be going on and on and on, but later everything collapsed and they felt like miserable about what they did. The United States economy actually in this financial crisis, this economy was not really hard hit. We cannot say that the United States could collapse in the end. The European Union, and especially the Eurozone countries, were much more hit by the financial crisis, by the euro debt crisis, because they had many banks which were on the brink of collapse. And a problem for Europe was that they had too much debt in their vaults. Again, banks, companies, people, general public, civilians, they were all indebted. The banking debt in the European Union, especially the Eurozone countries, the outstanding debt amounts to sort of 10 to 12 billion euros. So this sort of financial pyramid is threatening the European Monetary Union, the Eurozone countries, and these countries are not just those pigs, but actually there are banks which collapsed, went bankrupt in Germany, Great Britain, France. There were many financial speculations. So these sort of things were characteristic of any nation, of any developed nation in the world, in the early 2000s especially. They created unsecure securities, which sounds really funny, yeah? Unsecured securities. How can a security be unsecured? Well, actually, it can be very unsecure, because what they did create were financial derivatives, such as CDS, which is credit default swaps, or CDO, collateral debt obligations, some sort of other financial vehicles, and they developed those financial products, weather swaps, weather options, many derivatives. They created a financial economy, they created a financial engineering industry, they stopped doing real products, and the balance between the real economy and the financial economy was became really uneven. It became really uneven, and the financial economy outweighed the real economy, and the real economy suffered due to this financial crisis as well. There were many job redundancies, the investment opportunities decreased, people just were miserable about their future, and some people were not miserable. They did not suffer really hard when they lost their jobs, but they just started thinking that their future can be only secure if they do real things. So they started real businesses. Some of them set up new companies. These startup companies became a part of economic programs in many European countries and in the United States as well. So do not buy your own home, but actually start up your own business is now on the rise. This sort of concept, this idea is really important in today's economy, in today's economic situation. In Russia, that would also be a good thing if everyone starts up their own business. That would mean that you would do real things. So it's a good opportunity, of course, it's a good opportunity for your future. Of course, there are some sort of difficulties in Russia in particular due to bureaucracy, due to illegal activities, due to criminal activities of the organized crime, so to speak. So these are sort of things which do not help, do not stimulate the process of making our own businesses, of opening up our own shops and factories and things like that. We've got really poor agriculture, we've got really poor automobile industry, and many other industries are not really developing in the way they should have been developing, or they developed in the past. Well, banks and other financial institutions, and these sort of vulnerabilities which accumulated over the years, banks and other financial institutions failed to adequately monitor and manage the risks they were taking, especially exposures to subprime mortgages. Well, private sector vulnerabilities include two things, actually, two most important things. They included things such as firms relied excessively on short-term funding, such as commercial paper. Commercial paper, actually, I want you to understand this sort of concept, commercial paper. Commercial paper is just the equity of a company. That means shares in particular. These sort of assets, equity. And commercial paper can be issued onto the markets, in the financial market or stock market, and your shares or equities can be traded, and you may get profited from operating your shares. This process is also called IPO, IPO means initial public offering. When you issue your shares and you make the shares operate in the stock exchange, in the financial markets, you've got this sort of capitalization phenomenon, which really helps businesses in continuing their operations. Well, actually, when we say that the financial industry is a real threat to the real economy, this is not a total truth. The total truth would be that financial industry, in some ways, it helps actually the real economy, because it provides investment opportunities. The banking system, the financial industry is providing cash opportunities and investment opportunities because they've got the necessary capital for that. And innovations cannot be done without capital, because innovations are high-tech, is a really expensive sort of thing. It's a really expensive thing to develop and to produce. You produce ideas, and ideas cost money. You've got to have whole institutes, and you've got to have scientists. You've got to sponsor scientific conferences, and press conferences. And do not think that financial industry is always bad, and bankers and financiers are bad people. They are not. But sometimes when they participate too much in speculations, this is becoming a real danger. When they are doing it really all the time. So when you do it all the time, of course, that could be a threat. But in the end, investment opportunities can be provided only by capital markets, and they are operated by the financial industry. So real economy and the financial economy are sort of entwined. You cannot separate them, because the former, the financial industry, gives capital to the latter, to the real economy, and to real enterprises, to farms, automobile makers, mobile phone companies, smartphone makers, computer producers, so to the industrial economy. And this is good. But when you start producing exotic financial instruments, you concentrate financial risk, your financial risks are getting higher and higher and higher, and in the end they just stop thinking about these financial difficulty, and financial difficulties are accumulating and becoming real threats to the economic growth in your country. And that was the sort of situation in 2007 and 2008. On September the 15th of 2008, Lehman Brothers, one of the largest banking corporations in the world, actually one of the largest investment banks in the world, collapsed, declared bankruptcy, and it could sort of start a wave of financial tsunami. Other banks could also go bankrupt, but the United States Federal Reserve System intervened in this sort of situation, difficult situation, and they started rescuing banks. They started bailing out AIG. AIG is an American international group, a really great enterprise, the largest insurance company in the world, I believe. And then they bailed out Bear Stearns, Merrill Lynch, So banks such as these, they are the largest financial institutions in the world and the United States. But about this issue, we're going to continue studying this issue in later lectures on these financial difficulties. So today we really concentrated our attention on the vulnerabilities, on the financial risks in the economy. Well, public sector vulnerabilities include three things actually. There were gaps in the regulatory structure in the United States. Well, actually, legislation cannot be really ideal, perfect. There are no perfect systems. There are no perfect laws in any country. You've got to monitor the financial situation all the time, the economic situation in your country, and your laws, your legislation should be improved all the time, because the nature of business is changing, and especially it changes in the financial industry. If the financial industry, its most important characteristic is that it is really vulnerable, and it is really on the move, on the rise. This financial industry is developing too quickly, because you do not have to produce anything of you do not have to produce material things which you can touch and feel and smell and do other physical operations with them. These products are created out of thin air, so to speak. And when you produce something out of thin air, you do not care about other people, that they may suffer in the real economy, that farmers may go bankrupt, that whole industries may go bankrupt. You're thinking only about your speculations, and these sort of speculations became really widespread in the early 2000s. I told you about the dot-com bust and the dot-com crisis, when there were too many internet companies, and everyone felt that these companies would be our future. We will do everything, we will purchase everything through the internet or via the internet. We'll get electronic votes, electronic accounts, there will be electronic money, no money at all, no physical currency. But today we feel like we need these things in order to make sure that tomorrow is going to happen, and I'm not going to die tomorrow. I've got to have some cash, because this is our life, and this is an opportunity for me to support myself and support my family in this sort of way. So, well, there were failures in regulation, and there were failures in the legislation system, and you had to provide more rules to find new laws, and you should have continued in working with new legislation. And they created a new legislation, actually. It was called Dodd-Frank Act. So this law, this legislation, became the fundamental base of the financial industry reform. So we needed, in 2008, it was clear that we need the reform of the financial system. We should have new financial institutions that could monitor and that could prevent the economic system from collapsing in the future. And they started doing these sort of things. And the third problem with the financial regulatory system was that they did not pay any attention to the financial industry in those days. So that was the huge, the most interesting thing, or the most dangerous actually thing. The biggest mistake was that they took no account of what the financial enterprises were doing. They felt sure that nothing is going to happen, and but these things mattered really. There were really important signs, really important market signals and symbols in those period, in those days, but no one felt sure about that it's going to happen in the end. But still, the government, I think that was a real mistake. The government agencies, especially those financial agencies that were responsible for controlling banks, controlling stock market activities and things like this, they did not do anything. And that, in the end, led to economic collapse that we had in 2008-2010. So I would like to put a stop at this particular moment. I thank you very much. Today we learned a lot about the very process of economic crisis in the United States and in the world. We said a lot of things about the Europeans' monetary union crisis, about Greece and their economic hardship and the austerity programs. But in the end, I believe that we're going to overcome this financial crisis, and in Russia I think we also should be optimistic about our future, and we should be really working on the financial legislation. We should be really working on research and development. We should provide cash to and investment opportunities to to small enterprises, of course, to farms and things like that. We should be able to continue our economic development in that sort of way. So thank you very much.